All right, gents, we got 3 bangers today. First up, we got AI talent wars. Specifically, I guess what I'm interested in is these like Aquihires, right? So just for those that don't know, an Aquihire is effectively a way that one of these like big, like the Mag 7 type companies can avoid like M&A rules. So they basically buy all of the talent, they'll license the technology, but they don't actually buy the company. So maybe it's 6 of one, half a dozen of the other, but it opens up some interesting kind of nuances. But just a few examples. So Google bought Character AI last year for $2.7 billion, right? They licensed all the tech, they took all the people. Meta did the Scale AI deal, which was happened a couple weeks ago, right? For $14.8 billion. They bought 49% of the company. Most of that was supposed to go out. This is the news. I don't have any special information. Back to shareholders as a special dividend, but then they took Alexander Wang, who was CLAI CEO. He now runs AI at Meta, and they took out some of the other senior people there. And then just this past week, Windsurf was going to get acquired by OpenAI, but it looks like maybe Microsoft killed that deal, right? Because they have GitHub, so maybe it's a little too close to home. So now Windsurf is going to Google, and Google paid $2.4 billion to license Windsurf's technology, and they're also bringing over their CEO. So, fellas, what do you think about Aquihires? Right, Evan? Like, do you think this is good, bad? It's not a big deal. It's like a nothing burger. Is it open up anything interesting? Like, what if you're an investor in one of these companies? Is this a good result? Like, what do you think?
This is not a good result in my opinion. I think that these outcomes are a direct response to the regulatory challenges that these companies have faced in the M&A over the last 4 or 5 years.
Right.
I think that because of the challenges for M&A and the way that these companies are just getting around the rules so they can do the things that they want to do, which is acquire the talent, acquire the IP, and you effectively acquire these companies, and they're using these roundabout tactics, these acquihire structures to do that. And my view is that when you have these non-uniform transactions, these creative solutions, it creates a lot of risks for investors. It creates a lot of risks for employees. It creates just a lot of unknowns and legal hair and expense that at the end of the day, that none of that stuff, like uncertainty and creativity is generally not good for business. Businesses and the markets love certainty. They love structure, and they love like clear paths. Yeah. And so I think this is just a direct response to too much oversight, or not oversight, but too much regulation around the M&A environments. And someone's going to get hurt doing this, whether it's the employees, whether it's some of the preferred investors, the early investors, et cetera. So I'm not a fan of these structured deals. I think that they ultimately will leave somebody out in the cold.
Right. Nick, what do you think? Evan's not bullish, right? You have similar thoughts?
Evan is not bullish.
Yeah.
So all right, three.
You always know
things.
what Evan thinks. Evan old back. He's very clear.
So 3 things.
Yeah.
Or 3 keywords from Evans, and works well because the 3 of us all have good hair. This deal has hair on it. They all have weird hair on them, and absolutely, I think the way the market or individuals tend to react to the unknowns or uncertainty is generally negative. And I think the hair on this is that weirdly the way the structure shook out, it was not necessarily bad for Kleiner Perkins, Green Oaks, and General Catalyst, who were able to kind of walk away unscathed, but it was largely horrible for any of the existing employees that got left behind and didn't get brought over to work on the Gemini DeepMind, wherever they're going to get allocated on the other side with the CEO. And when you do that, it makes you question why you're even working at a company. Does the company have my best interests in mind? Or if the CEO gets a pretty sweet offer and, it wasn't going to shake out very well with OpenAI / Microsoft in the first place because they were just making it difficult, does that almost give me permission to jump ship the way they are here? And honestly, for the Mag 7, they're playing it smart. And this happens on smaller scale as well. But in this case, I think the nuance or the difference is when you're focused so much on LLMs, AI, the technology around Cursor versus Windsurf and things of that nature, it really is a massive talent war. And you could strip a business a lot faster when you focus on folks that are doing a new technology, as opposed to buying out like a barbershop in Omaha or even like a traditional data business or an insurance company. You can't just hire the CEO of an insurance company and be like, yes, we've got it. These are very, very different businesses. And that's why I think it's when you do a practice like that, first off, it is incredibly disruptive and lethal to that company that you're doing it to. But then, it should give investors pause about, is this a viable investment, or can the whole team be lifted out and disappear? Like, look at all the trauma happening between the OpenAIs, the original teams, and all these other companies. It's ripe for this sort of thing. So it's a very new territory, I would say.
Yeah, I gotta tell you, like I'm like a little torn on this, right? So tip of the cap to the bankers, you know what I mean, for finding innovative solutions to like make deals happen in the face of a regulatory regime that doesn't allow for these things to happen, I suppose. As an I just keep thinking about, like, if I'm an investor in one of these companies, am I excited about this? Like,
no.
Like character AI and character AI and Windsurf, you could be like, oh man, like this thing, you guys could keep going, and it could be like a 10, at 15, or whatever $1 billion exit. You know what I mean? Like, let it run for like another 3 to 5 years and see what happens, right? Like, you're getting out too early, you know?
I felt like with scale, I felt that was okay. And they can keep going and they could do well, and they lost a lot of their good talent, but the foundation of the business is still there.
Oof, you think so?
With much better than this, right?
The other two, you're saying, with Windsurf,
much better than like a Windsurf, or a character AI.
Okay.
Where that lift out is so detrimental to the value of the company and the remaining employees, it's just far too much.
Also, the IP, don't forget, they also get the licensing deal, so that the literally the core value of the company, which is typically the talent and the IP, are basically gone,
baked into the structure.
Yeah. Well, I mean, it's in Scale AI's case. I mean, I can't speak for Windsurf. I mean, Windsurf looked like it was doing pretty well from a revenue and customer acquisition perspective and growth perspective. But I mean, Scale AI was like a real business with real revenue and real customers and growing very fast. And I don't know, it just seems like there's a lot of value to that, right? So, I mean, I don't know. Like, I guess my thing is, like, I'm an investor, right? Like, at least with Scale AI, it's like a $15 billion exit, right? Or whatever they end up distributing. And, even if the other piece of the business going forward, whatever that ends up being, like, even if that's a zero, right, in the long run, at least you got something now. And maybe if you were in on like the Series A or something, you got a 3 or 4x. That's not bad, right?
I think if you're an institutional investor directly on the cap table, you are in a better position. But remember, in the late stage venture market, our market, the pre-IPO market, there are definitely SPVs. Good. There are SPVs where you're buying common.
No, this is not great. Like,
and it's not good.
Well, I would like to think, though, Evan, that like when these deals get done, and I don't know what happens with the rank and file or the common shareholders, but you would hope that they like pay those guys out with the premium too, right?
Maybe, but they might not be as good of a deal, and you're not legally entitled to it. So
that's
you
true.
are. I mean, what I'm saying is that's the uncertainty. It's like you're basically kind of hoping.
Yeah, a full face
someone around the table is a nice guy.
Yeah, a full face ripoff would not be nice. That, to Nick's point, like that would make you feel very sad. I think that
totally it would really. And remember, like if you work at Windsurf right now, you're an employee, your CEO, all of your top talent just left, your IP is gone, and now you have $100 million from Google, and you're like, well, what am I going to do? Like, I can spend that money.
Yeah,
but it's like, are you motivated to build the business? It's like, it's basically like stabbing you in the back.
Right.
So I don't think it's good for the ecosystem.
And then if you raised preferred at a decent valuation because you're hitting so much growth, you have all this talent, you strip away the growth because you got to start again, in a way, and then you strip away the top talent. You're like, oh goodness, we're in a spot, and that to both your points, the divide between the pref and the common just bulges out. So even the top talent that sticks around, the good guys and girls, I'm like, whoo, why wouldn't I just run off and join somebody else? So
yeah, I mean, look, I guess my thought on this is, like you start a company or you join a company like this. Like if you're joining a startup company, right? You're getting paid in equity. Like, let's just call it what it is. You're doing this to make a lot of money, right? So what do you care if it's an IPO, traditional M&A, or an Aquihire? As long as you get paid and it's like fair price, you know what I mean? For like the deal that you agreed to when you came in, money's green, all money's green, right? So like, it's all good. I don't know. Just like to your guys' point though, just people got to get taken care of. My thing is like, I'm assuming that the deals that are getting done make sense, or why would people do them? Right. I'm assuming, I guess, that senior leadership of companies aren't screwing over their employees. Maybe that's a bad assumption, but like, I don't know. I just like, if I'm just 2.7 and 2.4 feels like too low to do something like this, right? Like, unless you're just saying this company's going to go away in 5 years time anyway, but like, Scale AI at least was big enough where maybe that's okay. Like there was some podcasts I listened to over the weekend where the whole idea, they're like, the whole concept of human labeling data is going to go away because the AI is going to get so smart. The AI will label the data. So you don't need to scale AI anymore. Right. So like, there's that piece too. So I'm not so sure, but any parting thoughts on Aquihires before we jump?
For that, to digress, adversarial LLMs would be really interesting to discuss on 1 week. But no, I think Aquihires specific to a lot of what's being built for AI is a lot more dangerous than your traditional businesses that we've dealt with for the last 100 years.
Yeah.
So
yeah,
this will be very interesting. And honestly, they're starting to set a pretty big precedent between Meta, Google, Amazon, whomever. They're all after.
Yes.
They're all after the same sector.
Yes, but to Evan's original point, though, wouldn't it be nice if people could just buy companies because it made good business sense and they didn't have to worry about regulators coming in and
I still think
killing the
people
deal?
would look at this trade though. So you could either buy it and bring 100% of the people over, or buy it and bring the top 10 or 20% of the folks over that you really wanted and that are going to be blown into Gemini or DeepMind or, where specific. It may still work out better.
Well, you could fire the people, right, Nick? I mean, I know that sounds callous, right? But
you might be worse off and they might be worse off. Because
you probably
in a way,
have to pay,
yeah,
you have to pay severance.
Pentant. Yeah, exactly.
You have to pay severance. You're not wrong. You're not wrong. You're not wrong about that. You're not wrong about that. Okay, let's talk Fintech. So JPMorgan, I think this is a huge deal, this whole JPMorgan Fintech thing. So like, they're talking about now charging fees to the likes of Plaid, MX, Fincicity, etc. So these are companies that like will reach into JPMorgan Chase bank accounts and like, pull out data, whether that's validating that, Mr. Smith actually owns that account at JPMorgan, or validating individual transactions or whatever, right? So they go in, they pull some data out of JPMorgan and verify and give that to like a fintech, and the fintech does any number of things with that data to execute kind of banking transactions, right? Or payment transactions, etc. So they're talking about charging, JPMorgan's talking about charging fees. And in one case, this fellow on this Bloomberg article said that the revenue, the fee would eclipse revenue that the fintech would make by 1,000%. Right. So it doesn't seem like it's low. These fees are low that they're talking about. It seems material. So I guess my thought is, like, Nick, let's start with you, man. Like, there's a lot of fintech companies out there in the private market space, right? The shine has kind of gotten taken off these guys over the last, couple years. This whole Genius Act with stable coins is like kind of like revitalizing stuff, I think, a little bit for fintech. But this is not great. What do you think? Is this a big deal? Is it not a big deal? Like, what do you think about this JPMorgan thing?
Sure. Let's see. But on its face, I think this thwarts innovation across anything associated with fintech and payments. Effectively,
Agreed.
if you're able to build out a business that is complemented by this sort of data. So I want to know how many Netflix subscribers have canceled or recently joined or things like this, and then I can build up a data feed and sell that to a hedge fund or anything similar, remotely similar, or just be part of the payments process to validate.
Mm-hmm.
If we're coming in, is it that JPMorgan sees this as can't be a winner take all, but a victor take most? I don't know.
Right.
Someone on the podium does really well out of it, even if they have to step on heads along the way.
Right.
I think there's going to be a big trickle effect that's going to really negatively impact a lot of fintechs out there, unfortunately.
Right.
And
I agree with that.
Yeah.
I agree with that. Okay, Evan, let's geek out on maybe a specific example because I know you and I dabble in the payment space. So like the last time I looked at Plaid, it was like $1.50 or $2, right? If you wanted to send like if I wanted to open up a Robinhood account, I'm making something up. I want to open up a Robinhood account, and I'm not saying Robinhood pays these numbers. This is hypothetical, right? Yeah. And then I open up an account at Robinhood, and they do their thing, and they open up my account instantly because Robinhood's great, right? Now I want to link my bank account, and I have a JPMorgan Chase bank account, right? So I link my account, and I do instant verification. Type in my username and password to JPMorgan, and they, Plaid. That's usually like Plaid, right? Would reach out on behalf of Robinhood and bring that stuff back and reconcile the account. Everything matches. It's approved. You can now do an ACH pull. So Robinhood tells JPMorgan, hey, send me $15,000. And then the ACH gets initiated, right? Robinhood to JPMorgan. So if that cost goes from like $1 to $2 to like, I don't know, the way that these guys are talking, it could be like $5, $6, $7, $8. That's a big deal, I think.
Yeah, I agree.
Do you think anything you would change about that scenario, or maybe I got it wrong, or like, what are your thoughts on the impact of if that fee kind of dramatically increased?
You got it absolutely right. I don't know the dollar amount per se, but you got that. And to be clear, like before we had Plaid, there was a way to do this manually with micro deposit. I don't remember. We're not to date myself here.
Yeah.
Like
I'm old enough to remember voided checks.
Yes, exactly.
Paper clipped to a form that got mailed in to the brokerage firm, man. Voided checks. Yeah.
So, there were legacy ways of doing this that were worse. I think Plaid came in here and built a better solution. Another thing just to consider here, beyond the for the customer to link a bank account, is it also tells the receiving institution whether or not the account holds the funds necessary to make that ACH.
Yeah,
so you don't have an account overdraw.
Yep, smart.
So you don't have a returned ACH, which are more fees and challenges that hit the customer. So I think removing this or adding a fee to this is not good for the end customer by any means.
Yeah. This is what Nick was saying about innovation. Like, could you imagine if this got so expensive where people were like not using Plaid anymore and going back to the micro deposit verification or the voided check, like, oh my gosh.
Have you guys canceled a banking relationship in the past? So I finally took me quite a few months to unwind a horrible relationship I had with Bank of America. Not to say that I was, anyways. It took ages, and then they ended up charging fees for low balance after, problems with trying to get the accounts closed, which they wouldn't assist properly with, and all this stuff, just to unwind
it. Did you pay
them? Yeah, it was like $36.
I wouldn't have done it.
Yeah, not worth it. Not worth the aggravation to Bank of America. So in any ways, I got my accounts over to my next two banks, actually, whom have been great.
Okay.
So now let's say I have something with JPMorgan Chase, and now it's going to be $7 here, clipping in whatever numbers we've just made out hypothetically. Why wouldn't I move over to Wells Fargo or Citi or the next five?
Yeah.
But are people willing to do that if it's becoming such a pain and everything's so intertwined because you have loans, investments, mortgages, everything under the one roof, which is really nice. So
yeah,
I think it all depends, because if you have enough there, you might not care. Right?
Do you guys think that because look, Plaid's still private, right? MX is private. Finsicity is part of MasterCard, which is like a juggernaut, right? So I'm sure they don't break out revenue for that. But then, do you think that there's is there any coincidence that Chime just went public And then now magically this is happening where they're talking about like layering in fee. Because ultimately you would think like the fintech Chime is going to share a healthy portion of this increased cost is going to get passed on to Plaid's end customer, Chime, right? So is it now that they can see the financials and be like, wait a second, those guys are making all this money, plus they're at this higher interchange rate, right? Because they're, working with Bancorp Bank, you know what I mean? So like they got an unregulated interchange. They're giving them data for free. Like, like this is BS. Like we're throwing up gates.
Yeah. I mean,
now that I see it, I'm throwing up gates,
Yeah, I think reading the article and the way that Jamie Dimon discussed it is he's basically saying that like the connectivity of data through Plaid and other providers sort of commoditizes the concept of a bank, and it makes JPMorgan, who's got trillions under management, tons of security structure, policies, all the services under, and it makes them look like Rockville Center Bank and Trust, like the small little bank with a few $1 million, and it makes them all sort of ubiquitous and connected and almost the same. And he's saying that like it makes our brand look worse because we can offer similar services. Customers should come to us and they should use our services, and we should defend those services. I think that's I understand the argument, but I don't necessarily agree with it. I think it creates worse experiences for the end customer, and it ultimately really. It comes down to the concept of whether you believe your transaction data is your data or JPMorgan's. And to me, I believe when I make a transaction, when I pay my rent or I, pay my taxes or I pay a provider, a service provider, a vendor, whatever, like that's my data, and I should be able to take my data wherever I want.
Right.
You should, but that's a dual. Yeah, in my world, that's a dual IP. Unfortunately, we share it. Yeah, but to your point, yeah, he may be shooting himself in the foot, and now he's well smarter than I am, right? So he's probably not. But if I go into my QuickBooks now and I can connect every bank under the sun except for my Chase because there's going to be an extortionate fee associated, then I'm going to think twice about my business in QuickBooks. If I have to go into any other platform that's connective and there's an added fee, or I have to think about it. It's like when I go out to eat and someone says, "Oh, you want to use an Amex? We charge an extra something percent just because you're using Amex," or "We don't accept Amex." It could become like that dynamic,
Yeah, it's true.
Like a similar parallel is like what Costco did when they switched from Amex to Visa. Remember, it's like, do we think the customer is going to stay with Amex, or do they like Costco enough to get a Visa carded? I think we saw a very low number of people, not like
stop going to Costco.
Stop going to Costco.
Yeah,
exactly. Yeah, right. They want the Costco.
Yeah. Costco is a cult.
Yeah, I mean that,
in
but
a
that's
good way, in the best way possible.
Yeah, that's right. But Nick, like that's actually like that's to your point. Like that's the key thing. Like what Evan said is like, are people going to pick the bank or like the interface, right? So if I'm using QuickBooks and all my stuff's in QuickBooks, and now all of a sudden I can't tie my JPMorgan Chase bank account to QuickBooks, am I going to find a new books and records provider? Or am I going to find a new bank? Like, I don't call me crazy. I like people, your accounting software, using that example, like you live inside of that thing, right? Some businesses do. So like, I could see people being like, I'm not changing QuickBooks, so I'm going to get a new bank account.
Yeah, because if you use Xero or anybody else, you're going to have the same issue, right?
Right. Yeah, but in that one use case, but I could see other use cases where it'd be like, I don't really need that. I'll go use some other provider, and that Chase, doesn't have an incremental fee on. But I don't know. Just like to me, the innovation thing is what. First of all, I think to your point around private company stock price valuations and how this impacts revenue, I think you're right. You got to wait and see what happens, because it looks like there's some stuff going on with the Trump administration and the current, consumer financial, bureau that implemented this rule in the first place. Or they had a rule out there and now it looks like they kind of pulled it back. So we'll see what happens there. But so this may not happen at all anyway. But if this does happen, I do think it's going to negatively impact fintech valuations. I think is ultimately why I wanted to bring it up with you guys, because this seems like it's going to be expensive. It's not going to be like a little toll. It's going to be a 1 or 2% toll. It sounds like it's going to be very material. So, like, there could be an account opening fee. Like you almost have to charge it, right? An account opening fee now, or your profitability on a new account is going to go from 6 months to a year or something like that, right? Before you break even on that account. Like that's material, you know?
So being a negative Nancy on this, the worst case scenario is, it worked out for JPMorgan. PNC starts to do it. Capital One starts to do it. Bank of America starts to do it. You know, everyone just follows suit. And that could certainly happen as well. So wait and see is not the worst.
Not to get too cheeky, but then you have like this Genius Act stuff start, and then people are like, well, forget it. We won't use ACH. We won't use Swift and wires. We won't use Visa, MasterCard. Just do everything on the blockchain. And then instant verification, all of it's wallets. It's simple. There's some stuff that you'll just forget it.
This can go way
Fintechs will move outside.
I think you're absolutely right. If you're rolling back innovation at the traditional side, you will see that innovation double down on the technical and forefront side, and that will be a losing battle in the long run for the traditional finance players.
Yeah. Okay. All right. Sounds good. Let's talk rounds. So guys, like a lot of rounds this last week. We got Revolut they announced around $65 billion. They were at 45 last round. SpaceX, $400 billion round. I wouldn't be surprised if that goes up right from there. But the prior round was 350. Groq, $6 billion round. Prior round was 2.8 billion. That's Groq, the semiconductor company with a Q, right? Mistral, the French large language model business, 6.2 billion. The last round was 2, right? Harmonic, which is a mathematics specific AI model that Vlad Tenev, who's the CEO of Robinhood, is the chairman of, $875 million valuation. And then XAI, they did the $10 billion round a couple weeks back with some debt and equity, but then now they're talking about a $200 billion valuation round, which Musk has said is not happening on X. So maybe that's not happening. But anyway, just throw it in the mix. So a lot going on. So is this like a moment in time? Like Nick, is this like a moment in time? Is it just like summer and people are doing rounds over the summer? Which, not for nothing, that's kind of how some of this stuff works. Or is there actually something happening in the market that's warranting kind of this deal activity?
I think deal activity begets deal activity. And besides, let's say, a bankruptcy and aspiration, you've got IPO with Circle, Hinge Health, Omada Health, Chime, like DataStack's getting acquired or that being out there. A lot of the Aquihires that we mentioned in the first part of this conversation, everybody's having good success here, for the most part. So we're going to ride the wave. Or I forget the Charlie Munger, the surfing model, right? I mean, we're already on the move. Let's just pile in while we can, especially because last year was a bit tough. So no, I think there's just huge amount of momentum. And we're just going to see if it's going to fall flat or what will occur. But why not keep it up until somebody falls flat in their face?
Okay, all right.
That's just to be really generic about this response.
I got you. Evan, what do you think? Any thoughts on this? Is this just a moment in time or just normal cycles?
I definitely think it's moment in time. It's definitely a part of a cycle. I think that, believe it or not, that the opportunity of AI continues to be underestimated, I think, by everybody. And I think now the bigger it gets up and the bigger the market grows, the more you see the improvements at the model level, at the LLM, the customer usage, et cetera. I think people are just realizing like, this is where you back the truck up. This is one of those moments. And so you're just seeing these exceptional companies building exceptional technologies and investors who have tons of dry powder. Remember, they've been sitting in money market funds, trillions of dollars sitting in money market funds, and they're just sitting there being like, well, this is the opportunity and this is the time. So whether or not it's the frothy part or it's good or bad, like the pricing is good or bad will remain to be seen. But people are in the gambling mood right now. And I think if you're an operator and you're building a great company, this is the time to do it.
Yeah. I don't get the sense, like, I don't know, I guess I like live inside this, we all do, right? But I kind of look at these one by one, and every single one of these has like a different story. You know what I mean? So like, I don't look at it and be like, hey, it's a moment in time. Like they're all like, oh, everyone's going out raising money. Let's go raise money too. Like it's like kind of a natural cadence. Like, SpaceX does something every 6 months. Groq didn't do, they're like literally 1 year from their last raise. So they do something that looks like every July or August. So that's kind of like on brand for them. Mistral's doing something that looks like every 6 months. The 2 billion is something they did like fourth quarter of last year. They did something first quarter of this year that was at like the same valuation. So this is kind of like almost a continuation round. Harmonic's brand new. So no, kind of back tested. Revolut's interesting. So they did a round last year at 45, but it was trading down, right? Like Nick, PM Insights has it down from the 45. So then them coming out and doing the 65 is kind of like that's a very against the grain.
It worked the last time. I mean, I forget what the numbers were, but we saw it trading in the secondary market, 20% under the 45 mark. And this is around the time when people were announcing rounds, and then the secondary market would snap up to whatever that round was. Mm-hmm. Just wasn't happening, and then eventually with Revolut it did. So if it worked last time,
like why is it? That's the only stock that does that.
Yeah.
Is it because it's a European company? Like my only thought is like maybe that's just like European investors just refuse to pay a premium in the secondary market, so they're like forcing a discount, and then the company that comes out and does a round and it's up from the last primary round, right? That's the only thing I could think of, because that's just not how any other company operates. They're kind of secondary market, right?
Right. I mean, that's the most on its nose, but it's also one of the more traditional looking businesses that would be tracked along everything else that we've just mentioned, right? So they're not the most innovative company. They're not the most advanced cutting edge technology or anything like that. So maybe that's why it's slower to react. But yeah, everything is much more reactive in the secondary market that we've discussed today.
Right. Okay. So, last thought.
I won't bet against the Revolut on.
No, that is true.
Play.
I mean, they're growing very fast, and they have almost like no traction in the United States too. So I don't know what that's going to look like, but it'd be interesting to see if they actually get a foothold here. Right. Okay. So last thing on XAI. So I don't have any data rights or any kind of inside information on XAI, right? I just read what everybody else reads in the news. But the one thing that I just can't get past is, which I now think is a good thing, is that Musk wants to build 1 million GPU data center, right? So my understanding was that this new Groq 4 was trained on 100,000 GPUs. And Groq 4 is sick. It's awesome. I know we were talking about it before we started the thing. It's like, I'm like blown away. Like it's so much better than any other large language model that I've used, like full stop, right? In my opinion. That's only 100,000 GPUs. The guy wants 1 million. Like I can't even imagine what an AI trained on 1 million GPUs with a bunch of guys, like the XAI guys, they have like photographs of them sleeping in tents at the office. Like these people are animals, right? They like work to them bone. I can't even imagine what 1 million GPUs at that team's disposal is going to look like. It's going to be, that's like, you're talking like super intelligence. That's kind of the thing that everyone's talking about now. I have to imagine you're getting close to that, if not there, right? On 1 million GPUs. But here's the thing. What do you guys think? Like, here's my question for you. GPUs aren't cheap, right? Like from what I'm seeing, it's like for every 100,000 GPUs, it's like a $6 billion capital investment. Okay. So if he's got, my understanding is they got 300,000 now. So that's 700,000 more times the 6. It's like call it $40 billion of capital the guy needs to raise. Maybe there's a volume discount right? That NVIDIA gives if you're buying that much. But like, if you're the guys at XAI and you're like the merger valuation was 113 billion, right? You can't raise $40 billion on 113. Like you're driving up that valuation.
There's a start, you got your cross-pollination of SpaceX putting 2 billion of it into XAI.
But to me, it's more about dilution though, Nick. Like, what do you think about the dilution, right?
It's a massive punt. And it goes back to exactly what we're saying, that, so much dry powder is being deployed. Everyone has to see if this is going to work, because imagine if you were the one company in the year 2000 that didn't fully commit to the internet. You're toast.
Yeah.
That's lights out for you guys. So
yeah.
I don't know that the jump from 100,000 to 1 million GPUs is necessarily going to be much more than incremental. No one knows that answer because no one's been able to do it yet, right? And also this attack from the quasi acquisition of Scale AI, a lot of it's about the training data as well. So if you have so much more kind of training data, I think that would almost be more impactful potentially, but nobody really knows the answer until somebody's done it. And as the richest man in the world, why wouldn't it be him to do it?
So, why not?
I don't know. I think we're going to have more questions than answers halfway there.
Right. But I mean, can you agree though that if he does in fact pull the trigger and go to 1 million GPUs and spend the 40 billion, that valuation of this company is going to have to go up a lot? Right?
It would have to. Otherwise, we're getting diluted to hell. So
so like I mean, this is where you saw like OpenAI go from like 86 to 157 to 300. You know what I mean? Like I wouldn't be surprised if we're seeing something similar for XAI. Like it's in the $300 billion valuation range, in the next like 9 months.
Yeah, I mean, there's also a world where they do debt financing, right?
You know what? That's actually a good point. You know what's interesting about that, Evan? Like, I don't know if I've heard of anything around OpenAI doing debt financing, but XAI just did debt financing, right?
Yeah.
So
I mean, there's a world where the equity component is not the exclusive way that they raise capital for that sort of project.
No, but that's an interesting. Okay, but if you're in management team though, that's a very interesting differentiator, right? In how you're managing your cap table and how you're accessing capital, right? Equity versus debt. Right.
Yeah.
Plus two, it might be interesting, because XAI has less revenue than OpenAI at the same time, like maybe OpenAI can justify the $300 billion valuation and pulling in 40 billion to, not dilute themselves. But maybe if XAI did that without the same revenue base, it's a tougher pull. So you do the debt instead. You can always refinance the debt, I guess, right?
Absolutely. Or you can pay it off faster.
They would probably be treated much better, in the debt capital markets if they were public. So maybe that's a consideration. But I don't think that's in the plan.
True. That's a good point, Evan. I suppose I've obviously thought about debt, but I haven't thought about it in that magnitude. Like if they did, billions. I mean, I suppose CoreWeave's doing debt, but it's a little bit of a different revenue model because it's more direct, I suppose, right? Like they're literally selling that, data center, tokens or whatever, right? So like,
CoreWeave's now public and make it easier. So
right, but like you could really line that up. You'd be like, okay, company A, client, customer company A wants X. I need to build a new data center to service that. The data center cost me Y. The revenue from this is that. I can take that to a bank and wave that contract in front of them. They'd be like, oh yeah, sure, we'll give you the loan for that amount. You know what I mean? Like, or the investors for the bonds or whatever, right?
And private credit markets are massive right now. I mean, they're just getting bigger and more. They're massive and they're getting bigger and more mature, and they are expanding their reach into every single place, including the NFL. So, we're seeing it all over. So there's definitely a play to do half or some portion of it.
Right. Plus, I got to tell you too, like if to your point around credit investors, private credit, I mean, there's so much money in private credit. It's like bananas. They're all, I think, from what I hear, people are dying to find places to put it. So maybe that kind of delivers a better, interest rate to you.
Yeah. I mean, another thing just to, put a cap on this is that for 1 million GPUs, in Nashville, I believe is where they're building it. There isn't the energy capacity to have a data center that size. So
it's true.
While there's a whole level of infrastructure investment that needs to happen before that can even go live. So I don't think this is a problem that we as the markets are going to be experiencing or figuring out how to finance in the months timeline.
Here's a question for you though, Evan. Do you think Elon Musk will not find a solution to his power constraints?
Over what time period?
I don't know.
I mean, I do believe that man will find a solution. The question is whether he will find it in the next, he's also not the best at keeping to the timelines. He tends to be much more optimistic than reality.
Fair point.
And look, I'm, not to fanboy him or anything like that. I think he's he can definitely figure out a solution for it. But I don't think it's going to be the sort of thing that they figure out in the next 6 to 9 months or 12 months. I feel like this is
he does. Time. But that guy does. I mean, that guy does, like, you know, he makes like the impossible possible. Like I wouldn't put it past him to, you know, like go buy some
nuclear power plant just outside of where he's building it that's being decommissioned. He privatizes it and brings it.
Nick, it's like solar. You know, like solar. Like I can't even tell you how many times I've heard him say, like, you know, if you did a 5 mile, whatever crazy 50 mile by 50 mile square solar field, it would power the entire United States. Like I've heard him say something like that along those lines multiple times. Like, you know, like I would be saying he takes down, like he's in Nevada. Companies are headquartered in Nevada. Like he takes down like a huge portion of the desert or something, puts up a huge solar field, boom, you know, power for your data center. I don't know.
I hope you're right. I mean, I would love to know that solar is that efficient, but
he owns a solar company, right? He owns
Solar
City, right? Yeah. I mean, the wild thing is he could do it all within his own companies, theoretically, right? I mean, of course he'd have to make the solar panels, right? But the guy makes things. He's good at making things, right? So
yeah. Going back to it, I think he's going to find a solution. I just don't think it's going to be something that we as investors in the market need to be, you know, figuring out how to finance today. It could be a long-term contract. I mean, remember Stargate's still out there. There's hundreds of billions available for that. There's deep pockets of private credit. I think if and when that opportunity arises, we'll have more clarity on what the optionality is and how to finance it.
Okay, here's my big challenge. For you two and anybody who cares to respond to this. I'm dying to find a way to invest into electricity, like as if it was a commodity, right? I found one gentleman that does it. Like, it's not futures. He's like literally buying the electricity contracts and then selling them and like making a spread, right?
Yeah,
it's almost like a high frequency trader type thing. Like it's wild. He's like, yeah, I wake up at like 4 a.m. because the electricity markets, I guess, open up at like 4:30 in the morning. It's like that. Like he's super dialed in, this guy. I'm like, will you take outside investor money? He's like, I don't take outside investor money. He's like, it's my own money. Right? It's like crazy. The guy's he's a very wealthy man, right? All from this electricity trading, right? I can't find anything. There's no commodities there's no futures, there's nothing, right? You know, people are like, buy utilities. It's like, it's not the same thing, in my opinion, right? Buy nuclear company stocks, buy this. Like, I don't know. I want to buy the commodity, man. Like I can buy oil, I can buy natural gas, I can buy, you know what I'm saying? I want to buy electricity.
No, we got to tap Clint on this. This is his bread and butter. He loves this stuff. No, I would go air towards, you know, the interim of buying the nuclear company, you know, knowing how much energy we're going to need and how stifled nuclear has been in the U.S. That's I've done that and that's working out. But
you've bought nuclear company, like invested in their stocks?
Correct. Yeah,
I have too.
But
we talked about this. We talked about this end of the year wrap up, didn't we? Like what the things you're investing in.
We did talk about that. I'm putting this out into the universe. Okay. Someone please call me and tell me how to invest directly into electricity, because I will invest.
Okay.
Aaron.Dillon@agdillon.com. Please email me.
Can I
tell me how to do this?
Wait, let me tell you how it can be done.
I'm going to buy Aaron a hamster and a hamster wheel.
Right. I can tell you how it can be done. But here's the thing. So what you want to do, so there's two different things that you're discussing. There's one, like trading energy contracts, which are like SRECs, effectively available, like stuff that you sell back to the grid and back and forth. I don't know if you want to explicitly purchase the contracts. What you really want to do is you want to invest in
That's what this other guy does, I think. Is that what this other guy's doing?
What he's doing is trading.
Intraday, right?
Yeah, he's trading available electricity between what is available in access to the grid, which in certain states it's state regulated. So each state has its own structure, and actually it's regional. It's not even structured. It's like sort of like the Northeast region has its own trading contracts across states, across places, and you get these credits.
My understanding, he was literally the way he described it to me, and this is a couple months ago, so I apologize if I get this wrong, but he was literally calling like the companies that are generating the electricity, like the utility companies. and he was like, there was like Frank. I mean, come on, you know, like we're all New Yorker guys, right? Like this is how this shit works. There's like Frank at Commonwealth Edison or whatever, right? And he knows Frank. So he calls him up, Frank, I want X, Y, and Z this much. What's the price? He tells him the price. He goes, okay, sounds good. I'm a buyer of this. And then he's like, done. And then do the trade. And then he turns around and he goes to like the state of New York or New Jersey or whatever, and he sells it to the grid, you know, or sells it to some other utility that needs it because they didn't do as much production that day or whatever, right? That's like the market, as I understand it.
And so that is a way to invest in the commodity. There's a lot of different ways to get that. It's a credits swapping thing. So you're effectively buying someone's excess power utility and selling it to, if there's a market for that, you can definitely invest in that. But I think what you really want to do is you want to do the project finance for industrial capacity production, which is really where you get
I don't know. You know, I think I want the contracts.
You just want the contracts. But the thing is if you buy the production scale, like if you invest in the project finance, what ends up happening is that the power is actually purchased on a long-term purchasing power plan. So it's like you're buying 20 years at a certain kilowatt hour, and you finance that with upfront capital, and you get consistent dividends from production and or excess.
I don't want that either. That's what I'm saying. I don't want that. Like I understand what you're saying. I don't want that. I want the arb. Like, I just like there's not going to be enough. There's going to be more demand and not enough created. So I want to live in the middle of that.
So if I bought you the world's biggest Energizer battery, and you sucked up power usage in the middle of the night when no one's using their air conditioning, you sucked it up and put it in your battery, and then you sold it back to everybody when they need their ACs on during the day, peak heat. That's what you want?
I would do that. I would consider that. Okay. I would consider that.
Christmas list. 2025.
Listen, it's just like, this is where like my entrepreneur bells go off. Cause I'm like, okay, you know what? Like, if I can't figure out how to invest in this and it's too tough, then there's like an obvious opportunity here. Like I should start a business. You know what I mean? I don't know.
But if you believe capacity is going to continue to increase, like not exponentially, but directionally upwards, and capacity production is not going to be able to keep up with that demand, you will ultimately never have a scenario where the supply side will be able to offer you an opportunity to buy into it. You need to be the producer, because then you control the price.
Yeah, but that's like a different level of there's a different underwriting.
That's a long term versus his short term, right? So the short term volatility you can take advantage of.
I'm okay. I would even be okay doing the long term, Nick. It's just a different underwrite. Like now I gotta like who are the people building this? Who are they building? Are they going to be able to manage and maintain it over time? Like I'm locked into now that one site or whatever. Like. Whereas like if it's oil or natural gas that I go by the futures on, I'm just betting that oil and natural gas are going to go up or down or however you're trading it. You know what I mean? Like just on the simple level, you know, and there's a whole bunch of things that impact that, right? But on just like the simple level, it's, you know, you're betting on the commodity, the price of the commodity going up. Yeah. And I've yet to find a way to do that for electricity. Just the commodity.
Listeners, you hear it at first. Present us your options. We'll get you there.
Oh, I not only do am I confident I would write a nice check into that, but I have a lot of people that would pile in behind that. So anyway, anybody's got an idea, let me know. I'm dying to know it. I'm dying to find out. But all right, boys. All right. It's good talking to you. It's a great conversation today.
Cheers, guys.
I appreciate you, gentlemen.